It's just money. It's made up. Pieces of paper with pictures on it so we don't have to kill each other just to get something to eat. It's not wrong, and it's certainly no different today than it's ever been. 1901, 07, 29, 1937, 1974, 1987, Jesus, 92, 97, 2000, and whatever we want to call this. It's all just the same thing over and over. We can't help ourselves. We just react. And we make a lot of money if we get it right.
Welcome to Market Makers, your home for tomorrow's TA today. Often imitated, never replicated. Guys, if you were watching my video I posted exclusively on X last Thursday, we absolutely crushed the eclipse cycle pivot low. In this video, I'm going to show you the next leg for the breakout to hit our upside targets, when the market will rally to the day if we continue to play out to the fractal. So stay tuned for that. But before we get into the charts, I want to slay the beast. Let's discuss the elephant in the room. Because if you follow me on X, give me a follow there, by the way, at Market Canary for those exclusive updates. You'll see me talking to people or responding to people's posts about tariffs. Tariffs is all Wall Street can obsess over right now. You see it on FinTwit, you see it on YouTube, and you definitely see it on the mainstream media. Lee, throw up my chart. Goldman chart. Goldman asked their clients, what is the largest policy risk to the economy in 2025? 60% responded tariffs. You hear a lot of noise about the UMISH survey being the worst it's ever been. Let's look at the next slide. UMISH consumer expectations by political party. And this is where the disservice is being done by FinTwit, by the media. They're not breaking it out by political party. We know half the country hates the president, and it's reflected in the sentiment surveys. Look to the bottom right. According to the Dems, the U.S. outlook has never been worse. The outlook for the economy, according to the Democrats in the survey, is worse than the bottom of the pandemic, the global shutdown. It is worse than the bottom of the great financial crisis, which brought the world to its knees. It's skewing the data. The data set is not accurate. You have to separate your emotions when you look at the data, and we rely on people to give us accurate data to make decisions. And it's skewed because of the hate and the derangement syndrome that is rampant in the U.S. citizenry right now. So let's look at the one-year inflation expectations, the New York Fed versus University of Michigan. What's the Fed looking at for inflation versus UMISH? The Fed's looking at 3.13%, right? That's what they're looking at for the year. Whereas if you average the Democrats with the Republicans, you get almost 5% inflation. You know, what's kind of funny is they both could be right, and I'll show you that in the charts when we get to it. But, you know, fortunately, we have this 100 years of tariff history that we can look at. Nobody on Wall Street's going to look at it and do any research. So I thought I would educate you guys on how tariffs actually affect the market. They're not inflationary. They don't cause recessions or depressions based on 100 years of U.S. history. And to do this, let's travel back in time together to the 1920s. The 1920s, starting with 1922, the 4D Macomber tariffs go into effect, 40% across the board on industrial and agricultural products, the largest tariffs in U.S. history. Some of those tariffs exceeding 200%. So certainly you're thinking the 1920s must have been horrible. Inflation must have been rampant. The stock market must have crashed, and people must have been in abject poverty. What actually happened in the 1920s, commonly called the Roaring Twenties. Watch the film The Great Gatsby for a good glimpse into that time period. The Roaring Twenties, the stock market went up 500% that decade, 500%. The GDP grew 47%. But certainly you might think they must have had hyperinflation because they had the largest tariffs in the history of the country. The average inflation rate for the 1920s was minus 1.56%. That's right. They had deflation. Goods were cheaper as Americans built wealth. 500% increase in the stock market, 47% increase in GDP with the largest tariffs in history, and you had deflation. And then, of course, the market peaked in September 1929. Everybody panicked. What caused the bubble to pop? The same thing that causes every financial crisis. That's a separate video. The answer is the Fed. Now, you're hearing all this information and you're probably like, well, wait a minute, Brendan. Nobody's talking about the Macumber tariffs. Why would they? Of course, because that showed economic opulence, economic prosperity. They're all talking about the Smoot-Hawley tariffs during the Great Depression. And that led to the Great Depression if you listen to the mainstream media or FinTwit. Let's talk about the Smoot-Hawley tariffs. Hoover comes into office. He signs those into law in March 1930. Again, he signed these tariffs into law. What had already happened? According to the NBER, the official registrar for when recessions start, the recession, which became a depression, started in December 1929. So the recession already started. The stock market had already fallen by over 30% when that law went into effect. The stock market ended up continuing to fall. But just like today, all of the recessionary indicators had already triggered. So what happened when Hoover signed in that tariff law? Did you get hyperinflation? Did you get inflation at all? The inflation average for the decade of the 1930s was 1.5%. 1.5%. And more importantly, consumer prices on everyday goods you need to survive fell 30%. There's a lot of complex economic reasons why the recession happened, how the Fed handled it. They allowed over 9,000 banks to fail. 9,000 banks to fail. But it certainly and solely was not because of the tariffs. The tariffs, both in the 1920s and 1930s, did not produce inflation. They did produce opulence and massive wealth in the 1920s, and the recession had already started in the 1930s when that next tariff bill was passed. So just keep the data, understand the data, and what you're being presented on TV, on YouTube, on X is not accurate information. And I think the market's going to come to that realization, and you're going to see a snapback, which could lead to a blow off top and peak euphoria. Lee, let's go ahead and start the show. All right, guys, if you want to trade these markets, be sure to check out the sponsors, SimpleFX to trade everything if you live outside the US. That link's in the video description. And Bitunix that does not require KYC or VPN. Anybody can use it. Trade all the cryptos, our bonuses, our tournaments, exclusive to our links. Check those out. It helps support the channel. And be sure to like and subscribe. Let's start off on inflation. What I was saying earlier about how we could have inflation go up. I've showed you guys this several times, but back in the GFC cycle, we had Bernanke cutting, right? Bernanke was cutting. Inflation was at 2.8% when he first started cutting, way down here. As he cut, inflation literally doubled 100%. It went up to 5.6%. You could see that repeat. This is like the Peter Schiff narrative of inflation's going to get out of control. But what was the key takeaway? What should we have learned from the 1929 crash? What should we have learned from the GFC? It's a deflationary bust. Inflation went negative over 2%, even though it rose 100%. That little fractal, I believe, is going to repeat. Now, let's look at the VIX. VIX is dropping 19.83 off its peak. Again, that rally's coming, guys. We already have the rally off the pivot low. If we start off on the NASDAQ futures, this is what I want to show you guys. So again, we absolutely crushed the lunar cycle pivot low to the day for the move to the upside. But where I think the breakout is going to occur to come up to our targets is with the Fed on Wednesday. Now remember, the Atlanta Fed is forecasting negative GDP. 2 quarters of negative GDP equal a recession. The Biden administration tried to change that definition, but that's historically what a recession is contracting GDP for 2 quarters. So you have negative GDP, the super negative sentiment in the UMISH survey and in investor surveys. The Fed, I believe, is going to be dovish. I think that rally takes a leg up on Wednesday and moves to our targets. From a fractal perspective, and this is what's interesting as a pattern trader, from a fractal perspective, look at how the NASDAQ formed previously a year ago. As you know, I think we're repeating this W. So you look at your low. Then you had 1, 2, 3 days. That third day was the pump up. What did you do over here in the modern market? There's your low. 1, 2, 3 days. The third day was the pump up. The next 2 days, if I expand this so you can see this, the next 2 days were basically a doji closing slightly higher and then a doji closing slightly lower. If we complete that little 2-day fractal, that's the Fed day, right? So you would have tomorrow being another doji, and then you have the Fed on Wednesday. What happened after that? The breakout to the upside. So again, does it have to be a 1-for-1 ratio? No. Pretty amazing if it is. But when we look at how long we rallied off of our pivot low to the midpoint of the W, we rallied for 13 bars, 17 days, 15.4%. And if we look at where we're going to rally to, if we just mimic the exact fractal, 13 bars, 17 days, anybody could draw that. What's the significance of that? That's the next lunar cycle change to the day. And when did we peak in the previous fractal? We peaked with the lunar cycle change in the NASDAQ, right? Within a day here of the lunar cycle change. So that's what I think's happening. Now the targets, as we discussed in the previous video on X as well, pulling our fib down from 1 to 2. I think you're going to come up to the bottom of this Wyckoff fractal. 21,000, you have the 618 at 21.1, the 72% at 21,430. Over here on the left, you came all the way up to the 72% retracement to the dot at 19,966. So these higher level targets, I think you're going to see this follow through with the Fed this week as you see the NASDAQ, the S&P, everything start to snap back to the upside, find resistance, and then ultimately pull back. And if we hold the higher low, this is where I think the blow off top comes into effect. Because how do markets peak? They peak and peak euphoria. I think the tariff, the fear mongering, it's all overdone. The market's going to come to realize that, and you're going to see people pile in and drive this higher. Now let's go ahead and jump over to the S&P. S&P, same concept. When did we peak at the midpoint? The lunar cycle changes, right? So I drew this the same way. Up day across the board here, 56.82 on the S&P. I have the bottom of my Wyckoff fractal at 58.50. If we pull a fib down, you're looking at the 50% at 58.37. So that makes sense as a target. Could go higher to 59.15 or 59.82. It all depends on the ferocity of the rally. I anticipate Powell being dovish because of all the negative data, right? And if he is dovish, and if he signals at all that they're considering cuts, or maybe just some generic language like, hopefully rate cuts can begin soon, I think you're going to see a massive pump in the market. So that's something that you want to watch for in the marketplace. And of course, you want to hold your lows in all these markets. And your low, which you made on the eclipse cycle, was 55.09. Nice pump up today. 56.83. And then if we look at the DAX pumping up 23.2. Again, Germany is considering that $500 billion additional spending bill, beef up defense and some other things. I think the DAX is going to get euphoric, go up to our complete upside target here of 24,622. And that's what I've been waiting on. We've been hung up at 23. I want to see this get to 24,622, and it can do that in confluence with the US rally. So look at Bitcoin. Something I did on the 3-day chart on Bitcoin. I just want to measure the waves. The waves before we start going sideways in our Wyckoff fractals. 105%, 98% went sideways, 91% went sideways, sold off, and 124% went sideways, sold off. Interestingly, when you zoom out to this larger perspective, look at the drawdowns here in Bitcoin. When you look at the drawdowns, you had a nice 33 Dow retracement, 33% Dow retracement in that previous fractal. What did you retrace so far on Bitcoin here? You retraced 30%, 30.36. Again, mimicking, right? Mimicking the prior retracement. Upside targets, 132, 142. And again, I drew these waves, these gains of an average of around 100%, 105, 98.5, 91, 124. Let's just look. If Bitcoin holds a low here at 76.5, what would this be if it comes up 90%, right? 90% move, which is done over and over again in the waves up, takes you up to basically 145, right? Again, 132, 142, somewhere in that range. To come to my 132 target, it's a 71, 72% move. If you did a 100% move, which you did multiple times on these waves up, you're looking at 154K Bitcoin. Again, my targets are based on Fibonacci and based on confluence. So again, I think my target is easily achievable of 132. If we check our fib from the all-time high down to our fractal low, the 1618 lines up perfectly at 130,582, and the 200% takes you to 143. Again, that's my target range, 132, 143, and we'll see what happens and how euphoric the market gets. Bitcoin is at 84.3 as I'm recording this video. If we look at Bitcoin on the daily, what do you got to take out? What everybody in retail and basic looking TA YouTube is looking at, the 200, right? Get above the 200. Guys, you got to get above this grid. We talked about it. Get above 92, and then your next key resistance is 100. Once you get above 92 and you can hold this area like you did for a very long time, you elevate above 100, and this is where the magic happens, and this is where the breakouts happen to the upside to these higher level targets. You want to see Bitcoin hold the low at 76.5, continue to make progress, take out the 200, move up into our grids. If we look at some other altcoins here as well, I showed you guys this concept as well, where some of these coins I think are good accumulation, not financial advice, just my opinion. Every single time in the last year, Solana has broke below 113. It has achieved massive gains of 66%, 170%, and we broke down to 112 here. You're currently at 128. Any type of dip in this area, I would look to accumulate for myself anyways. That's all I'm speaking for. Down here with Solana in confluence with the markets continuing to move up. I expect Solana to come back up to higher levels, exit 188, and give us some higher prices, okay? It's going to lag behind what Bitcoin's doing, and you have to see the markets move up as well. Looking at XRP, same concept. Anything below $2.01 has given you nice rallies of 43%, 73, 60%, 55%, and you got below $2 again. Currently at $2.35. You know, maybe we can get, if we're lucky, another pullback in some of these assets to retest this support down here. $2 on XRP, 113 on Solana, and if we do, look at what the markets are doing, because look at your own view. If you're bullish on the markets, I like those accumulation areas. If you're bearish, then you wouldn't like those accumulation areas, and it would be confluence for you that you think things are turning around and going down even further. Guys, I hope you enjoy the video. I answer your comments as always. I am active on X. Give me a follow. Check out marketmakers.trade and join our trading community. Fantastic people there. Over 20 countries in the room. Talk to you guys on the Thursday video on X.